Hey everybody, Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is my subscriber request series Tuesday that I've been doing here for the last couple of weeks, and I'm kind of enjoy this because it does give me a chance to speak directly to you, the subscribers of my YouTube channel here, and try to cover things that you guys are interested in. Now, I'm going to kind of combine two birds with one stone in this particular video. I'm going to cover a specific stock, Stellantis, which is a merger, as I'll show you here in a moment, between two major automobile manufacturers. And I'm going to also talk about, another subscriber asked me to see if I could cover kind of a Peter Lynch turnaround situation. Peter Lynch mentioned 7 different types of stock categories in his famous book, One Up on Wall Street, and one of them was the turnaround story. And turnarounds can be very, very intriguing, especially over the short to intermediate term. So I'm going to try to cover both of those concepts in this particular video. However, the main story that I'm going to be telling here is the merger between Peugeot S.A. and Fiat Chrysler. And they merged into the company called now Stellantis. And it's a very broad-based company where it has business all over the world. I'm going to go ahead and look at it a little bit from the standpoint of what the company does. You can see they have operations all over the world. They have numerous brands, which I'll be talking about here. But what I really wanted you to see is that this company, by merging, is actually becoming a much stronger company. The company does the majority of their net revenues come from North America. They do pretty decent business in South America, but Europe is their second biggest market. Middle East and Africa is also a growing market for them, as well as India and Asia Pacific. And then they also have the Maserati brand. So that's going to be interesting. This is a very interesting company, and let's go ahead and look at it from the point of view of FastGraphs. Now, the problem is I don't really have a real graph here, and what I mean by that is I believe what I'm looking at here is the old Fiat graph. In other words, historically, because this merger happened in January, the middle of January, I think January 16th to be precise. And so I really don't have anything that gives me what I would call real accurate historical information on this company. So just about everything we're dealing with here is the future. And what we're looking at is the future of what Stellantis might actually do. Now, it is expected to grow very dramatically going forward. And let me go into a couple of external sources here and talk to you a little bit about what other analysts are thinking. So I'm going to first go to Morningstar here. And Morningstar is not really covering the company from a standpoint of giving it their star rating. They talk a little bit about their fair value, and they do say, assuming the merger with Peugeot is completed, which it is, they think there's going to be some cost synergies, but their fair value estimate for the combined entity is roughly $22 a share. Now, if we look at Stellantis today, it's trading at about 17. Using the fast graph here, that $22 a share would be kind of consistent with what we're seeing on fast graphs. But the real key here is what the future looks like. Okay, so I'm using adjusted operating earnings here. So let's look at forecasts going forward. Now, there are quite a few analysts following this company. There are 24 analysts that expect earnings of $2.54 for this fiscal year, which of course ends in December. Now, 6 months ago, they were only forecasting $1.72, but that was pre-merger. And then 3 months ago, that kind of increased to $2.37. I'm going to guess in anticipation of the merger. The most previous estimate was $2.52, and that's even increased to $2.54. And likewise, we see a 17% expectation for 2022, earnings of $2.98 estimated, and it was $2.38 6 months ago. And again, that's steadily increased. And then it drops down to 13 analysts, but it's still a pretty good consensus. Look for pretty good growth going out to 2023. I tend to like to focus more on these first 2 years here. So looking at these, if I'm using the P equals growth rate formula, Peter Lynch's famed formula of, for growth stocks, and this is also another opportunity to show you another company that's expected to have very high growth going forward, that's trading at a very low valuation. The blended PE is 10.59. The earnings yield is 9.44%. And I'm not showing any dividend yield at this point because the dividend is still perhaps up in the air, but there are expectations for the company to be producing a growing dividend income stream. If I look at the historical graph, there wasn't any dividend being paid historically, so the combined company may give us that. Now, some clues to whether that may happen or not might be looking at the company from a standpoint of operating cash flows. But again, the historical graph here is really looking at one of the old companies here. I'm not even sure which one it is, so I wouldn't put too much credence in that. But, the company did generate operating cash flow, but it always traded at a relatively low price to operating cash flow. And I do want to point that out. So if I'm going into the forecasting graph here and I'm using the normal multiple, of 2 times cash flow, then, the stock still has pretty good rate of return opportunity going forward. I've got fewer analysts giving me operating cash flow forecasts, I might point out, so I have less of a consensus here. But, it still looks like the company looks pretty interesting, going forward. So, I kind of like that. Now, if I go back to adjusted operating earnings here, I do want to make another point about this. And I'm going to show you some other automobile manufacturers here with this video here in a moment, because I just want you to get a perspective. One of the things about this particular industry is it does have what I'll call a reasonably spotty record of analysts being correct. So if I'm looking at the old company pre-merger, you can see analysts, when they were making 2-year forecasts, were wrong about half the time. When they were making 1-year forecasts, they were wrong about 1/3 of the time. So that's something I do want you to take into consideration here. The forecast here going out 1 to 2 years, looking at adjusted operating earnings growth of this 23% per year, is something that you might think is, reasonable. And the company, I'm going to show you some guidance here that the company's doing in a moment. But the reality of it is you want to be skeptical, because before I go on with this stock, let me show you some other examples of automobile companies. I've also been asked about Tesla. I've recently covered Tesla. I'm looking at operating cash flow here. Tesla is beginning to grow and generate positive numbers. They've been producing negative numbers historically. The stock has had a pretty sharp drop here in the recent months or so, but it's still far from being down to what I would call a fair value. But anyway, that's Tesla very quickly. But let's look at some more traditional companies. This is Toyota. I want you to look at their analyst scorecard. I want you to notice that, Toyota's, the analysts have been wrong about 1/3 of the time. Japanese automobile manufacturers produce probably the most consistent operating results. What I really want you to see here as you look at automotive stocks, very, very difficult for this industry to make money. You can see the earnings have been all over the place here for Honda. They're up and down, up and down. There really hasn't been any growth. When you look at long-term performance of a company like this, even including dividends, they have very low rates of return. That's very typical of these automobile manufacturers. Here's Subaru. Again, you have a period where they really did very poorly. They actually lost money during the Great Recession. Then they had this very strong surge in earnings. But then in recent years, earnings have been collapsing. They've cut their dividend and even eliminated it numerous times. So these are very unpredictable companies. The analyst scorecard of a company like Subaru, how accurate the analysts have been making a 1-year or a 2-year forecast is, again, very, very spotty. That's something I want you to take into consideration as you're looking at these graphs here. Moving on, let's go ahead and look at General Motors. Now, General Motors just came out of bankruptcy, so I don't have a long history here, even though this company's been around a long while. But again, I want you to see this surge that's happening. Now, I do want to do something here. I want to go in and get a quote on General Motors right now, because something that I do want you to notice is that the automobile industry, there's a lot of companies in the automobile industry right now, as you can see here, that are, Tesla's up a little today, but Ford is down, Toyota is down, and so on. So the automobile industry kind of seems to be under a little pressure. The next company I want to show you is Ford Motor Company. Now, I find this astounding, and I want to make a point here. I've talked about this before when I've talked about Ford in past videos. From a standpoint of statistics, Ford really didn't look that bad not too long ago. But now we've eliminated the dividend primarily because of COVID. We've got a very low earnings yield. We see a very spotty record. But this is what's astounding about this company. Had you invested in this company, roughly 20 years ago, in other words, if you'd have put $10,000 in Ford on December 29th, 2000, and held it through yesterday's closing stock price, you can see a very spotty record of dividend where they've cut and even eliminated the dividend numerous times. The $10,000 investment you originally made would have shrunk to $5,482. And even when you add $3,200 in dividends to the equation, you still end up with a negative rate of return. It's very, very difficult to make money investing in these automobile stocks. Here's Mercedes-Benz, Daimler, AG. Again, you can see a very spotty record. Earnings go all over the place. When you look at long-term performance here, we get about 3.8%. Here we have a much better dividend record than we just saw, but we still have very unpredictable investments. And again, we're looking at companies where the analysts are expecting very, very strong growth. But I go on, I want to show you BMW. BMW is pretty popular here in America. The company's earnings, again, are all over the place. Their dividend, rises and falls. Again, we're seeing it coming from an extremely low valuation last year in the throes of COVID. We've had this nice recovery, and we are expecting, good growth going forward. So what you've seen here is that most of these automobile companies are expected to have good growth going forward. But I do want you to understand that these companies have very, very difficult, challenging operating historical environments. It's very, very tough to make any money. If I showed you the profit margins of these companies, you would find that they're all over the place. Their margins, rise and fall almost like the wind. So I guess the point I'm making is when you're investing in automotives, these are stocks that you really have to watch very closely. And Stellantis, although very interesting, is a company that you have to be very, very careful with. Now, their forecast in their most recent report to shareholders, their most recent presentation, I should say, they gave a 2021 industry outlook. They expect North America, which is their biggest market, if you remember, to grow by 8%. South America, a rather small market, to grow by 20%. Europe, they're expected to get 10% growth. So these are their two biggest markets, North America and Europe. Middle East, they're looking for marginal growth. India and Asia Pacific, and then China, they're looking for positive plus 5% growth. Now, the company is moving, like most companies, into the electric vehicle, the green deal. And this business, they do have some really interesting brands here. And let me go ahead and take a look at those for you. The combined Stellantis here has some really strong brands. Of course, Chrysler, Dodge, Fiat, Jeep, Maserati, which is a kind of a fringe business for them. If I showed you it had 1%, they have Opel, Ram, and then they sell, automobiles and parts in their free to move business. They also have Alfa Romeo, Citroën, DS Automobiles, I'm not real familiar with them, and of course Fiat Professional, Lancia, and so on and so forth. So they do have, quite a diverse group of brands here, and they market these in different places and different aspects, across the world. So it's a very interesting company. If these forecasts are correct. Now, if I look at the analyst scorecard, which I believe is the Fiat scorecard, again, it's normal, just like other automobile manufacturers I've shown you. But the point is, we can't really rely on this data right now, because what we're really looking at is the new company going forward. And it is expected to be positive. It is expected to initiate a dividend. That's still yet to be seen. The company does have tremendous growth prospects. And, if we just stay close here, look at the next couple of years, this could be a very intriguing turnaround situation. If you look at it from a standpoint of, recovery coming out of the COVID pandemic, the stock's already had 159% recovery. Again, Morningstar is giving it a fair value of 2022, but they're not yet finished with their report. And that's the other message I really want to get across here. I don't really have a lot of conviction on this stock, because even though I've got what looks like historical data, I really don't. What really you need to do here with a company like this, when you've had a merger, you need to really, watch this company for several quarters to see how they're doing, pay attention to their guidance, and see if the synergies of the merger are actually taking place, if the company's, blending well together. They're very, very optimistic. Analysts tend to be very, very optimistic going forward here. So I would call this a speculation, but one that may be worthwhile speculating on. It's got very intriguing looking future prospects. It doesn't have great brands. The company is committed to what they call mobility. They are committed to zero emissions, in the future, which most of the automobile manufacturers today are singing that song. So anyway, this is Stellantis, kind of an interesting stock. I'm not real familiar with it, because to be real candid with you, for the reasons I've shown you here, I've never been a big fan of investing in these automobile manufacturers. Their records are just too spotty. They're too cyclical. They have a great deal of difficulty making any money. But as you can see, there's a lot of positiveness looking out to this industry. So This is one where I put my famous admonition, caveat emptor, buyer beware, in the report here. In other words, be very careful here. You could make some really good money over the short to intermediate term. I don't believe any of these are really great long-term holdings simply because of how difficult it is for them to make money and how competitive the market is. And it's a very capital-intensive industry as well. Now, Morningstar does point out that, they don't give it a moat because they say there really is no, barrier to entry. They do talk about that quite a bit. And so, they talk about the automobile as a modern-day technological marvel that requires enormous engineering talent and organizational skill to design, develop, and bring to market. A lack of barriers to entry is evidenced by global industry overcapacity of roughly 30 million units. So with all this positives out there, there's a lot of overhangs that I think you ought to also be concerned about. Anyway, this was my subscriber request for this Tuesday. The merger between these two giant industry icons have now merged together to create a really kind of broad group of different brands. They do operate all over the world. It's something you might want to take a closer look at, but I would definitely do my homework here and try to figure this one out before I got too aggressive with it. Anyway, this has been Chuck Harmel. Thanks for watching. Give me a like as always. Subscribe if you haven't. Ring the bell. Do all the things that would help this YouTube channel grow, because I really appreciate all of you and I really enjoy. And then we're going to stay on with the subscriber request series on every Tuesday, so you might want to check in next Tuesday for that as well. Thanks for watching.